external liquidity concepts, and also rebalances. Okay, so these are actually what makes about 50% of ICT, to be sincere. But most of us only know about the other side of the 50%. Okay, so internal and external liquidity concepts will be going very deep into what they are, and I will also be showing you my charts as well, just to show you how to picture these things on your charts. They happen on every time frame, they happen every day, and they happen every month. Okay, so the first point I have here is that price moves from external liquidity to internal liquidity. What this means, you get to find out as we progress in this video. Another point I have here is price moves to fill in imbalances, then to take out stops. This you probably already know this, that whenever price is trading, we run stops, right? Buy stops, sell stops, even liquidity pools. That is what price likes to do. So these 2 points actually are the main reason why the market will always create impulse and corrective. Now, what I mean by impulse is whenever you have market break structure, let's say whenever you have a bearish break in market structure, that is impulse wave. Then you'll be looking to take a sell on the retracement, right? And that is the corrective wave. These times are actually from retail, but I am using them because a lot of you are already familiar with them, so it will be easier to communicate this information to you. Okay, so another thing is that market will always hunt stops, always, right? Every single time frame, it is hunting stops, and that is what it likes. That is what it has been designed to do. So the first one we're looking into is internal liquidity. What are they? What they are? How to find them on your charts, and some definition of terms. Some things you already know, and then some things are just like added benefits or bonus in this video. So the first thing I'm looking at is, let me just explain what internal liquidity is. Internal liquidity is just when you have price trying to go to areas inside of past price action that has not been properly traded. I will explain using another set of words. Internal liquidity is whenever price is trading, or whenever you have some irregularities in the delivery of price, such as fair value gap, for example. When you have fair value gap, it means you have a large candle that just trades very fast from a particular area, and then price for a while has refused to come back to that level. Then that particular candle that created that gap becomes our internal liquidity. Why? Because we are now looking at the body of the candle. We are looking at the candle body. When you look at buy stop and sell stop, what are you looking at? You are looking at highs and lows, right? The wicks, the tip of the wicks. But when we are looking at internal liquidity, we are not looking at the wick. We are rather focusing on the candle body now. So do not don't mistake this, and don't make any errors when you are making use of this in your chart. Be specific whenever you are looking at internal liquidity. Know that you are dealing with the body of the candle, and whenever you are dealing with external, you are dealing with the wicks. We already know that. Okay, so the first one is the BISI, which is the buy side imbalance, sell side inefficiency, and the other one is sell side imbalance and buy side inefficiency. So the buy side imbalance is when you have a bullish candle that creates a very, very long body, or that creates a kind of fair value gap. Let me put it that way. We're using fair value gap because that's what you all already understand as at this level. So when you have a green candle, meaning a bullish candle that closes with a massive body than the wicks, that's number one point, that closes with a massive body than the wicks and also has a very, very large body at the same time, then that creates a buy side imbalance. And why is it a sell side inefficiency? It's a sell side inefficiency because price bought, and during the phase of that particular candle while it was buying, there was almost no selling activities, or should I say sell orders being placed at that particular moment. And we all know that the market is not one-sided, it is two-sided. It's both, it belongs both to the buyers and the sellers. So when you have one-sidedness in the market, that is when you see a candle just going in one direction and then not minding the fact that it has to do two things at the same time. That is, it has to buy and sell. I'm not saying price buys and then sells immediately. What I'm saying is you don't just see um, candles just flying up without some retracement on lower time frames. It doesn't happen. You will still see some retracement on lower time frames that would now be your weeks on higher time frame. Okay, so everything I explained about buy side imbalance, reverse is the case for sell side imbalance. So the third one here is the voids. We already know the voids. These are created mostly when the market opens on Sunday nights. Also, when the market, when new session opens, probably from Asia to London or from London to New York. So when new session or when we have intersessions, then you get to have voids. And voids are just whenever you have price jumping. And what I mean by price jumping means it's kind of crossing over some price levels, and I'll show you that in the chat also as well. So there are reasons for that, and that might be due to high volatility or maybe high impact news. There's so many reasons that can happen. So moving on to the next point I have on my screen, both of these are in short fair value gaps, meaning the buy side imbalance, the sell side imbalance. Why are we using buy side? Why are we using all this language? Because we want to pinpoint what exactly we are looking at. We are not just saying fair value gap. What fair value? What gap? Where is price coming from? Where is price going to? Where should price refill the gap from? We want to know all this detail, and we have to be specific about what we are doing. That's what we need to master this imbalance and inefficiency from the sell side or from the buy side. Okay, so moving on, and the process of price right here, and the process of price coming to fill up the gap is known as fair valuation. Okay, so price can also move from internal liquidity on a higher time frame to another internal liquidity on a lower time frame of same asset or currency pair. Now, what this means is that if you have a 4-hour buy side imbalance, sell side inefficiency, a 4-hour candle like that, inside that 4-hour candle, if I go down to 1-hour charts, or let's say 15-minute charts, I'll still be able to find some fair value gaps that price is likely going to fill inside of that 4-hour candle. That is my higher time frame fair value gap. Okay, I will also try to find a particular scenario in the market where I can show you this as well. So now moving on to external liquidity. Remember that in internal liquidity, we are dealing with the candle body, right? And we are dealing with the fair value gap in short. But now we're talking about external liquidity. We are now more concerned and focused on what happens on the wicks of those candles. Okay, that is why you see me anytime I chart, I place my buy side liquidity on top of the wicks or beneath the wick. when it's a down close candle. Buy side liquidity or buy stops, anyone you want to call it. I use buy side liquidity when I probably have double tops. It becomes a buy side liquidity pool. But when it's just a single unprotected high, then it's a buy stop. Same thing for sell side liquidity or sell stop. So a lot of people just pick one high and then they call it sell side liquidity. I am not going to say you are wrong, but the point is that is actually not the right term for that. You have to be specific and you have to know exactly what you are looking at, and you have to be correct with your annotations. Okay, single highs, single lows, they are buy stops, sell stops. Double bottom, double, all the retail patterns, they are liquidity pool, as long as price stays there for a very long time. But if price just comes there once and rejects, then it becomes a single point of liquidity. Another point I have for external liquidity is hold highs and hold lows. These ones are they are majorly seen on weekly, monthly charts, or even daily charts. That's 2017 on the monthly chart. There is a particular high that price is trying to go to. Then that becomes your old high or old low. So price is always attracted to liquidity at all time. Now, what do I mean by this? What I mean is price is always attracted to liquidity at all time. Not necessarily. A lot of you, all you know about liquidity is buy stop and sell stop. But now I'm opening your eye to internal liquidity now. Okay, and price, the same way price is attracted to those buy stops and sell stops, is the same way it is attracted to those internal liquidity that I've been showing you. They are actually more than this. You go and do your research and and then you get to add more to this. I just don't want to fill this presentation up with too much information. Okay, so same way price is attracted to buy side liquidity and so on, is the same way they are attracted to those areas of inefficiencies in the marketplace. So either an external liquidity or internal liquidity, same things happen over and over again every week. Now, this is an example. Look at this high. This is US dollar index, and it's a daily chart. Okay, so this high and this high, look at how price neatly and perfectly formed these equal highs. So that becomes our buy side liquidity point number one. Whenever we're trading such, in fact, when market was trading here, I called a buy right from this. If you can remember, I called a buy from this daily buy side imbalance. Okay, if you can remember. If you can't, just go through the mentorship, all the setups I've been posting, and then you get to see the trade. Okay, so this was a high and this was also a high, and then we had a daily massive bullish candle like this. Okay, how do you identify the buy side imbalance, sell side inefficiencies? You look at the candle after, and then you look at the candle before. Then you pick the low of the candle after and the high of the candle before. Then that gap is your fair value gap, which precisely is your buy side imbalance, sell side inefficiency. So we expect price to come fill up that liquidity, that internal liquidity, before buying to the external liquidity. Now, from my presentation, I said that price moves from external liquidity to internal liquidity. But right here, you can see that it can happen both ways. Right here, price moves from external liquidity, because when price came to this high, it formed double top, right, and daily, and that is our buy side liquidity pool. That is external because it is outside of the candles. Then we drop down into this fair value gap, which is the internal. So we left the external, we came to fill the internal, and then we went back to the external. So like 1, 2, 3. Okay, so in order to cut this story short, and just to give you what this thing actually is, we came to fill about 60% of the fair value gap, and then we rejected. In rejecting, something happened again. They created another fair value gap right here again. So I marked that same candle, the candle before. Now, what you would want to notice is that the candles before and after your bullish or bearish massive candle, they are always majorly small. They are always majorly small. That's your first indication. If you look at this candle, see the body. Look at this candle, see the body. Then look at the one between. Look at this one again. Look at this, and then look at this compared to this. Okay, so the one between becomes our fair value gap. Now we had the fair value gap there again. I expect the price to come fill up. In fact, I posted this particular one that price would come and fill the daily fair value gap again, and then buy back to take out the external liquidity. What if we come here and price does not make it to that area? Then that might be an indication that price will reverse, and then dollar index will be weak. That might be a clear indicator. But for now, dollar index is still very, very bullish. Okay, so this is actually 25th of August, and you can see that price is just sitting right inside of the fair value gap, which is specifically the buy side imbalance, sell side inefficiency. So I hope and I'm sure my explanation is clear enough. Now, before I move on to the next, I want you to know that you might be looking at this area and then you're finding that this might be your order block, even though it's not, because definition of what actually qualifies an order block is that the candle body has to be larger than the wick, right? Now, you might be looking at this particular candle, the price has to come and touch it before it buys. But the point is that as long as we fill 50% of this fair value gap, you can start taking your buys, because that is the consequent encroachment or mean threshold. And most of the time, we like to see that particular candle we are trading, that price stays above the mean threshold. The same thing with other blocks. We don't like to see the mean threshold or consequent encroachment of the order block to be violated as well. Okay, so when you see price respecting about 50% of the range of the fair value gap, that might be a clear and good indication to take your trade, and then put your stop loss below structure where you think it's safe. Or while price was here, you start seeing market structure on 15 minutes, and then you can find a very, very protected low to place your stop loss. Okay, so to the next one. Now, the last one is rebalances. Rebalances of prices when the market price reprices back into certain areas. Please, I typed this myself. Everything you are seeing here, I didn't copy from anywhere. They were all typed just from my head. So if you are seeing any grammatical or wrong spellings, just ignore. So rebalance of prices when the market reprices back into certain areas of imbalance and inefficiency. I'll stop here. See this full stop. I'll now explain. Okay, I'll also explain with the charts as time permits. So rebalance is when you have imbalance and then you have price go back into that area of imbalance to fill up that area. It's called rebalance. Okay, it's called rebalance. These areas such as gaps and voids can be regarded as weak points in IBDA. IBDA means interbank price delivery algorithm. This is what delivers price on your chart, where there hasn't been enough and proper trading activities or execution of trade orders. So what I'm trying to say here is that when I started explaining this, I told you that whenever you have very fast movement of price away from a particular area, they tend to create fair value gap, and that becomes one-sided, and that is not a proper price action. That is not a proper way at which IBDA actually works. Okay, so price tends to go back into those areas to refuel all the orders that were not executed. Some people call it mitigation. Okay, so price goes back to mitigate orders, and then that is when you as a trader also have the opportunity to take your trade, and that is why they call this institutional trading, because that is how institutions trade. They look at inefficiencies, they look at gaps, and they expect price to come to those areas for them to load up their positions. They are discounts, they are premiums, and they like to take buys from the best discount price ever. I explained this in the last set of videos. So price trades back into these areas to fill up the weakness in price delivery. There are of two types, as explained in the chart below. The most popular one being IBR. In fact, I have a friend that trades just his Telegram name is IBR. Very funny. His Telegram name is IBR, and it means immediate rebalance. What I noticed about smart money concept is people tend to pick what their strength is in. There's a lot of information out there. They just tend to pick one thing and then they focus on that, they build on that. But is that enough? It's not. You cannot go to a nursing school or a school or a particular school where they teach you to become a doctor or engineer, and then you say all you want to do is just 2 years and then you're okay to go and start practicing. Or all you want to do is you just want to learn how to prescribe drug to patients, and then you don't want to learn how to diagnose or how to carry out surgeries or how to take deliveries. You just want one thing, and then you're okay with it. You want to go away. That is what a lot of people do. A lot of ICT guys who claim to be doing good with ICT, all they know is Orderblock. But even the other block that they know is not even enough. They do not even understand 50%. They don't even know half of what Orderblock is. Last week I explained refined Orderblock, how to refine your Orderblock, how to find Orderblock inside of another the same Orderblock. How many people know that? Did you know that before? No. There's institutional Orderblock. When you use COT on daily charts, when price traces back to a particular order block, and then you look at the orders of that of price upon coming to that order block again, then you want to relate it with the last time they made a high. That is institutional order block. How many people know that? They just know that up candle, down candle, which is not even what order block is. Order block is not even the candle. It's not. Okay, so don't just pick one thing and then you say yeah, okay, except you're just trading for fun. If you're trading, if you want to trade for a living, 10 years from now you want to be trading, then be a professional. Don't be lazy, do your assignments, submit on time, watch the videos, practice, and submit to time. Okay, so IBR means immediate rebalance. What I showed you here on this chart, right here, they are not immediate rebalance. They are not immediate rebalance. When you have price trading away from a particular fair value gap for 1, 2, 3, 4, 5, about 4 days, away from this area, then that is not immediate rebalance. Immediate rebalance, I will show you what it is and how to use it. This one is also not immediate rebalance. I actually don't know what they call this, but just take it as what I have explained here. Okay, so the last on the presentation is consequent encroachment. What this encroachment means is that this is the main threshold of a candle dealing range. Meaning, if you have a green candle, okay, I will just use this chart. I think I've even explained what this means already. This range, then the 50%, that is your CE. So now this was a mistake. Let me correct it. All right. So we will be, whenever you're looking at the 50% of a particular gap, then that is the consequent encroachment, and we will be considering the candles open and then the candle close, not the high or the low. When you're talking about the high and the low, then you're looking at the wicks, but we are not looking at the wick in this instance. Okay, so now looking at this chart, I'll be using this chart to explain why you don't get deep retracement and why price will just keep flying in your direction, and how to just be a smart trader. I'm a very smart trader because yesterday I was trading and I was just laughing like, what have I become, or what have I made of myself in this trading? Because I just know exactly what will happen. And I'm not saying this because I want you to feel like I am one ICT guru. No. What I'm trying to say is, if price is not going to come down, look at this breaker here. I would know. And I will not expect it to, and it will not. I'll take my buy here, and it will buy. I posted a chart on gold, and I bought gold. Even so many other guys I know that we trade ICT were selling gold yesterday night. I took a buy, I took my stop loss, I set it, and I was like, price is not going to come here. It will just buy from this my entry. And then I woke up this morning, did just that. It didn't retrace to the breaker, it didn't retrace to the other block. It's already, maybe during the weekend I'm going to explain how that happened. Okay, so that is exactly what I'm trying to teach you so that you'll be able to do the same. Now, back to the chart. There's a breaker here, and then there's a bullish break in market structure. Correct. Then you as a smart money trader, you want to buy on return to order block, which is this black candle. Or if you're looking at this breaker, you also want to buy on return to breaker, which did not happen. Price just kept buying. It just kept buying and kept buying. How would you have treated this? This is what I like to look at. Whenever you have, please pay attention. Whenever you have a break in market structure, such as this, with this massive candle, if the next candle fills up that gap that the candle that broke structure created, then do not expect price to come back to your breaker or to your other block. It will just keep going. They always come back to come and do what? Rebalance price. If they do this IBR, which is immediate rebalance, I learned this from ICT's mentorship, not his YouTube. I learned from his mentorship myself. Okay, so you can't find this anywhere. That's why I'm giving it to you now. So you have to pay attention. When you have the candle after and the candle before in a situation like this, and then it keeps rallying, do not expect that price will just come down again. If they do, it might just continue selling off. They should not. Okay, so we have a break. We have this break in market structure, right? we have a breaker here, and then look at the candle after. What happens? It trades all the way down, almost totally rebalanced this particular massive candle that created a fair value gap, which is a buy side imbalance, sell side inefficiency. Okay, so what happened is that what happened was that we had a break of market structure, bullish break of market structure, price traded up. The next thing I would have loved to see was the next candle just kept on shooting up without any rebalance. But in a situation like this, where you have the price trading all the way down this way, closing up the fair value gap, almost sometimes they even close below, then they go back up, they trade below, and then they go back up to close. In a situation like this, then they rally. When that happens, this mostly happens on Euro. This happens on Euro almost all the time. I used to miss trades where I would expect price to come back here or come back here, then I would draw a line here and then call the point of interest. Then price will just do a little pullback and then continue buying. Then before you know, you've missed your setup, you've missed your trade, and then you're just confused. And I'm telling you what happens right now. So take note of the candle that breaks the structure, which is this one. Take note of the candle after. If the candle after, it might not be the immediate one. It might be the third one. It might even be this one that will come down a little bit to close up the gap, and then it rallies up. In a situation like that, don't expect price to come to this area again. Now, what should you expect? This is what you should expect. Expect that price trades up, creates a new fair value gap here, comes into that fair value gap, consequent encroachment, that will be your buy. Then your stop loss will be below this area, or to be safe, right here. Okay, so how would you have gotten your buy on this particular trade? It's very simple. All you have to do is, while price was trading here, just go to 15-minute charts. Then you would have seen that this was a breaker that price was trying to approach. Then you would have found your entry right here. So this is immediate rebalance. Sometimes it's extremely perfect and it works very, very well most times. That it will come to this particular horizontal line before buying. So when you see that, you can always take your buy. In fact, there's a guy on YouTube that uses this particular method, and he has called it. He gave it another name. He calls it one-on-one, one-to-one, something. I can't remember. And he's also a very smart guy. He looks at the breaker, which is this massive candle. Then when he comes back to mitigate the last candle high, he takes his trade there. So it's super sniper entry. If you can do it, then do it. Example of another immediate rebalance is this. Price came to this mean threshold of this fair value gap. You can see the two horizontal lines. I took the candle before and then the candle after. The price came into it. That would be my daily range to buy, and then it bought. After buying, this also created a fair value gap. Then we had an immediate rebalance back to fill up more than 50% of this gap. So in a trade like that, price probably will not come back to this order block. Are you getting it now? So why do we like to take order blocks? We like to take order blocks when we have a fair value gap candle next to it that has not yet been rebalanced or that has not yet been balanced. Okay, so this might be a lot of explanation, but we already spent 36 minutes and I'll be ending the video right here. If you have any other question, you can ask me, and then I will attend to you. So I just spent 1 minute. I said I was going to explain this area, but I didn't mark it out. If you look at this candle here, and then look at the candle after, also look at the candle before. This is the complete definition of a fair value gap, right? This is Sibi, this is Sibi, which is sell side imbalance. Then what happens? Price closes, trades back into that Sibi, goes to this the Sibi, they call it Sibi, the Sibi low, the Sibi low, which is the low of the candle before. This is the CB high, which is the high of the candle after. So the CB low and the CB high gives you your fair value gap or your sell side imbalance. We closed in perfectly well, then what happened? They dropped. Now, you might not have been able to take this if all you know is just order block, because this does not even meet the definition of order block, this particular candle. Well, if you're unable to see order block, how would you trade this without this information? Would you be taking this one as your breaker? Then you will probably have drawdown. Okay, take it here, take your sell, then the price goes your way. I hope you understand, and I hope this was simple enough for you to understand. Thanks for watching. I'll see you and I'll talk to you in the next video. Bye.